Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Amgen stock so we can determine if it's a buy or a sell. Amgen is a biopharmaceutical company. It is focused on molecular biology and biochemistry. Its goal is to provide a healthcare business based on recombinant DNA technology. Its biggest product is Prolia, which strengthens bones. So it's prescribed for people with osteoporosis. Another big product is Enbrel, a tumor necrosis factor blocker used in the treatment of rheumatoid arthritis and other autoimmune diseases. The name Amgen is short for Applied Molecular Genetics. The company is headquartered in Thousand Oaks, California, and was founded in 1980. Let's get started with the model. This is a large cap company, 125 billion market cap. They're trading at $232 a share, and they have 537 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their numbers are pretty consistent from 9.2 billion to 8.8 billion. It was highest in 2020 at 10.5 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that declines from 7.8 billion to 6.6 billion. Revenue is a sales for the company, and that steadily grows from 23 billion to 26 billion. They recently released their first quarter earnings, and for the first quarter of 2023, they had 6.1 billion in revenue, down from 6.2 billion in the same time period in 2022. I'll show you a breakdown of this 6.1 billion. The biggest revenue generator is Prolia, 900 million, 600 million in the US, 300 million in the rest of the world. Enbrel is mainly sold in the US, 564 million, and this is just for the first quarter. All these drugs have revenue above 250 million. So annualized, they could all have 1 billion of revenue for the entire 2023. That's a really solid portfolio of drugs. All their other drugs totaled 1.7 billion of revenue. 2/3 of their revenue is in the US, 4 billion, 2 billion in the rest of the world. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. All the expenses to make the drugs as part of cost of revenue. R&D 1 billion, SG&A 1.3 billion, and other 148 million. So total expenses 4.2 billion, up from 3.7 billion. I'll show you on the 10Q where it gives more detail on these expenses. Cost of sales increased to 28% of total revenues, and that's driven by higher amortization expense, changes in the product mix, and expenses related to restructuring, and higher profit share expense. Profit share is stock-based compensation. That's when a company pays employees with stock. The increase in R&D was mainly by late-stage development, research, and early pipeline programs. The increase in SG&A, selling, general, and administrative expenses, was higher general and administrative expenses, including acquisition-related expenses. Other expenses are related to restructuring, and we need to look a little deeper into the 10Q to get more detail on that. So their operating income is down from 2.5 billion to 1.9 billion. Interest expense of 540 million. This is the interest they pay in their debt. That's up from 300 million. They had a lot in other income, 2 billion. That could be the gain on the sale of a subsidiary. So their net income is up a lot from 1.5 billion to 2.8 billion. EPS increased from 269 per share to 532. Let's look at the capital structure. 4 billion of equity, 39 billion of debt. They're 9% equity, 91% debt. Their net debt is 30 billion, so they have about 9 billion of cash on their balance sheet. I gave them a WACC of 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 206 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $185 billion. We divide that by 537 million shares. And we get a calculated stock price of $345. They're trading at $232, so they're trading at a 33% discount. It's a buy according to the model. Simply Wall Street is higher than me. They're at 406. They say the stock is 43% undervalued. 12 analysts price this stock, and the average price target is $259. The low is $185. The high is $325. That's quite a spread. 19 analysts price this stock, and the average price target is $253. They say the stock is 9% undervalued. This is where the stock has been trading from 1983 to 2004. You can see they did 5 stock splits. So as the stock price goes up, a company usually does a split so it's more affordable. And it is hard to tell on this chart, but it looks like it was steadily rising from 83 to 91. Then it really jumped up the next 2 years. It fell down in 93. It was down to about $5. That's split adjusted. Then over the next 6 years, it grew to $20. And that was at the very end of 98. And there was a huge bull run from 99 to 2001. And it got to almost $80. And then the dot-com crash, it fell to about 35. Then there was another run up past 70. And then it started detracting a little bit in 2003 and 2004. From 2004 to 2012, it pretty much traded sideways. It was around $50 in 2012, and then it got up to about $300 at its peak. That was in the third quarter of 2022. It has come down from that peak, but it's trading a lot higher than what it was pre-2020. And you can see they started paying their dividend in 2011, and they consistently paid it each quarter since then. They raise their dividend each year from $1.32 in 2018 to $2.13 currently. It's a yield of 3.7%, 52% of their free cash flow, 70% of their net income. There are 15 companies in the same industry as Amgen, and if Amgen has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend $1 billion in CapEx, a little more than the median. They're by far the most leveraged company on this list. For every dollar of equity, they have $10.60 of debt. They do pay a good dividend, 3.7% above the median and average. Their free cash flow is pretty similar to the median. They're not a small company, 125 billion market cap, but they're 10th on the list because most companies of this industry are really big. They have a terrible price to book ratio, but they have a good PE and price to free cash flow. Their price to sales is about average. They generate $26 billion in revenue, a good amount below average. They're not really growing anymore. Their 5-year annual revenue growth rate is 3%. The average is 8%. To summarize, I have them trading at a 33% discount. This company has been around 43 years. They have a lot of great drugs in their portfolio and in their pipeline. They are a bit leveraged, but I don't see that as a concern because they're bringing in so much free cash flow. And they do pay a nice dividend. So for a long-term hold, I think it's fine. I rank their free cash flow as 4 out of 10, their revenue 6 out of 10, and their ratio 6 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to become a member, click on the link in the description below. Thanks for watching.